Welcome to Breaking News to Trading Moves. Today we are looking at a scenario playing out in the capital markets that touches on the huge ambition of AI development and, well, the cold reality of how you actually pay for it. Our focus is a legal challenge facing Oracle, that's ticker ORCL, about the debt they've taken on to fund their big AI infrastructure build-out. We're going to walk you through the specifics of the dispute, and for you as a listener, identify some of the companies that might gain or lose based on how all this shakes out.
That's right. What we're really examining today is just how capital-intensive building out this next-gen AI capacity really is. This Oracle situation is a perfect case study in how fast investor scrutiny around debt and disclosure can change the market dynamics, and not just for one company, but for the whole ecosystem around it, cloud services, data centers, all of it.
Okay, so let's start at the top, the core facts. A Reuters report came out saying Oracle is being sued by some of its bondholders. The basic claim is that they feel they were misled about how much more money Oracle would need to borrow for its big AI push.
Yeah, it really all hinges on the timing, on the sequence of events. For context, you have to remember Oracle had just announced this absolutely massive deal, a $300 billion 5-year commitment to supply OpenAI with computing power. That alone signals a rapid, very expensive expansion is coming.
And it was right after that news broke, when the market was buzzing about all that potential new revenue, that the bondholders put their money in.
Exactly. On September 25th, investors bought about $18 billion of Oracle bonds. They bought them based on Oracle's financials at that moment, which suggested a certain amount of debt and a predictable plan for the future. The price they paid reflected that level of risk.
So they're investing with the idea that, okay, there's a stable, predictable path for taking on debt to fund this growth. What happened next?
The shock came when Oracle then very quickly went out and raised another roughly $38 billion in new loans. These loans were specifically to fund the new data centers they needed for that AI buildout. For those original bondholders, that sudden large chunk of new debt changed the entire calculation for their investment.
Hold on. Oracle is a massive company, very solvent. I mean, $38 billion is a lot. But why does the bond market care so much about how they fund their growth? Isn't this just business as usual?
That's a great question. It's not just the amount, it's the timing and the potential subordination of the original debt. When a company takes on $38 billion in new loans, those loans are often structured as senior debt. What that means is, in the unlikely event of financial trouble, those new lenders get paid back before the original bondholders.
So the new debt essentially cuts in line.
Precisely. This big increase in total debt and the priority that new debt might have, it immediately increases the perceived credit risk for those first bondholders. Higher risk means the market wants a lower price for those bonds, and that's the damage they're claiming. They're saying they were blindsided.
So this is much more than just a legal fight. It's about the promise of AI hitting the reality of what it costs to deliver.
And that's maybe the most important point for you, the listener. It's a reminder that AI infrastructure requires an enormous amount of capital investment. CapEx, as we call it. We're not talking about software updates. We're talking billion-dollar data centers, cooling, specialized chips. It's real money.
And when the market sees these huge CapEx plans,
Yeah.
what are they watching that tells them the risk is going up?
Well, now everyone is going to be focused on leverage ratios. They're looking at debt to EBITDA. How easily can the company's profit cover its debt? They're checking interest coverage ratios. Can they actually pay the interest on this new, larger pile of debt? When investors see a lawsuit like this, they immediately start recalculating the weighted average cost of capital, or WACC, for these tech companies.
And if those numbers start to look worse, the whole AI build-out story looks a bit shakier, a bit more expensive.
It does. If investors begin to question the transparency of financial reporting, or if the overall cost of borrowing, what we call credit spreads, starts to rise, the market reprices everything.
Can you just define credit spreads for us?
Absolutely. A credit spread is just the extra interest rate the bond market demands over a risk-free rate, like a U.S. Treasury bond. It's the compensation you get for taking on the risk that the company might not pay you back. When spreads widen, borrowing gets more expensive.
Okay, so if Oracle is feeling some of this pressure, who stands to benefit? It can't just be their direct rivals. Let's get into our first category of potential winners.
The first and most obvious group are the cloud competitors. The other, hyperscalers.
And hyperscalers is just the industry name for the biggest cloud providers, right? The ones operating data centers at a global scale.
That's it. They provide the computing power and services for everyone else.
So if Oracle's AI timeline gets questioned, or if their borrowing costs go up, where do those big enterprise customers go for stability?
They fly to certainty. Customers who need continuity and scale, they get nervous if a platform might face delays or funding problems. Any doubt about Oracle's ability to execute on its expansion plans is a direct benefit to the established leaders.
Which brings us right back to the biggest names in the game.
That's right. You're looking at Microsoft, ticker MSFT, Amazon, ticker AMZN, and Alphabet, which is ticker GOOGL. They are the clear alternatives for anyone needing massive AI capacity.
The second group of winners is a little different. It takes us out of tech and into finance. The credit and market data firms.
Yeah, this is a direct result of the market's change in focus. When something like the Oracle lawsuit happens, investors suddenly put a premium on understanding corporate debt, credit risk, bond market mechanics. You can't just trust the growth story anymore. You have to dig into the balance sheet.
It's that classic move from focusing on reward to focusing on risk, and people need better tools for that.
Exactly. When that happens, the demand for credit ratings, for fixed income benchmarks, for credit research, for analytics, it all goes up. This debt needs to be reassessed, and other companies in the space need to be looked at too.
So firms are paying for more analysis, not just of Oracle, but of the whole sector's disclosure practices.
They are. This points you directly to the companies that provide those ratings and that data. Specifically, you're talking about S&P Global, ticker SPGI, and Moody's, MCO. This lawsuit basically creates work for them.
And for our third category of winners, we're looking at companies that sell the solution: governance and risk software. If the problem is bad disclosure, the solution is better internal controls and software.
That's absolutely correct. The lawsuit puts a spotlight on the quality of offering documents, on internal controls, on the whole compliance process at big companies. When investors and regulators start demanding more transparency, companies have to strengthen their reporting processes and their software solutions.
So, better software for tracking the complex process of borrowing and spending capital.
It is. Companies that specialize in managing those financial workflows and compliance are set to capture this new demand. We're looking at firms like ServiceNow, ticker NOW, and Workiva, ticker WT. They provide the tools to make complex reporting and internal audits smoother and more transparent. All right, so now that we've covered who might gain from all this increased scrutiny, let's flip it and look at the potential losers. These are the companies most exposed to Oracle's specific risks and to the broader negative feeling around these big debt-fueled AI buildouts.
And of course, we have to start with Oracle itself.
The main problem for them is layered. You have the lawsuit risk plus the higher perceived credit risk from all the new borrowing, and that puts pressure on valuation multiples. The market might have been pricing Oracle based on its great AI growth story, but now it has to adjust for the cost and the risk of that financing.
And what does pressure on valuation multiples mean for an investor?
It means that for every dollar of future earnings the company is expected to make, the market is willing to pay a little bit less today because the risk has gone up. And the broader market takeaway here is caution. Investors might get a little shy about any company funding massive projects, mainly by taking on new debt.
Who else, besides Oracle, has a structure that might make investors a bit cautious in this environment?
Well, you could look at a company like IBM, ticker IBM. They're a major player in enterprise tech and cloud, and they've also used their balance sheet for growth and for acquisitions. Any general market nervousness about debt-fueled growth in enterprise tech could create some headwinds for them, too.
Now, for our second category of potential losers, let's go back to the hardware. The company selling the servers, the networking gear, all the stuff that actually goes into these data centers.
Right. If a huge customer like Oracle has to delay or even just revise its build-out orders, maybe because of legal issues or rising capital costs, the suppliers are the first ones to feel it. They can face delays in orders and just general negative sentiment from the market.
That's just the reality of the supply chain, isn't it? If your biggest customer slows down, you're left holding inventory you thought you were about to sell.
Exactly. Even if long-term AI demand is still there, and we assume it will be, it's that near-term risk that hits quarterly results and stock performance. If Oracle taps the brakes, their suppliers feel it immediately.
Who are we talking about specifically in that infrastructure space?
This would include companies like Supermicro Computer, ticker SMCI, Hewlett-Packard Enterprise, that's HPE, and Dell Technologies, DELL. And you'd also have to include key networking companies like Arista Networks, ticker ANET. They provide the high-performance switches that connect all these AI servers. Any hiccup in Oracle's plan creates direct uncertainty for all of these suppliers.
And finally, let's look at the financial institutions themselves, the big underwriting banks that manage these bond offerings. They're involved here too.
They absolutely are. Lawsuits over securities, especially related to bond offerings, always raise the compliance temperature. When the complaint is about misleading disclosure, it's a headline risk for the banks because they're responsible for the due diligence on the deal.
They have to show they thoroughly checked the company's financial situation before they sold the bonds to investors.
That's the heart of it. This forces these banks to increase their internal compliance costs, and it increases investor scrutiny for all the big debt deals they underwrite going forward. The cost of doing business just went up.
And this would affect the largest underwriting banks, the big capital market players. So JP Morgan Chase, JPM, Bank of America, BAC, and Goldman Sachs, GHS.
This whole situation is really just a powerful example of how quickly capital market issues can challenge even the biggest technology strategies. The conversation around AI often just focuses on the tech risk, will the product work? Will people use it?
But this Oracle scenario reminds us that the financing risk, the ability to afford and properly disclose the massive costs, is just as important. You have to look at not just the promise of the AI, but also the way a company plans to pay for the foundation it's built on. We'd encourage you to think about how this kind of financing scrutiny might influence other companies that are pursuing ambitious debt-funded projects, especially with interest rates where they are globally.
As always, we must conclude with our mandatory statement. This discussion is not financial advice or recommendation to buy or sell any security. It is purely the opinion of the author.